There's a study that almost nobody talks about. Fidelity ran an internal review of their best performing accounts over a 10-year stretch. The ones that crushed everything. Beat the professionals, beat the algorithms, beat the obsessive day traders refreshing charts at 3 a.m. When they finally tracked down the account holders to study what they were doing differently, they discovered something that broke the narrative so completely that it barely got reported. The best performing investors were dead. The second best had forgotten they had accounts. That's not a joke. That's not an exaggeration for effect. The people who performed best in one of the largest brokerages in the world were people who did literally nothing. Not because doing nothing is some kind of genius strategy, but because doing something, the thing you believe makes you smart, is almost always the thing that's destroying your returns. And you're doing it right now. You probably did it this week. You checked. You adjusted. You read an article and moved something. You felt informed. You felt responsible. You felt like a person who takes their money seriously. And that feeling, that precise feeling of being in control, is the most expensive emotion in investing. By the end of this, you're going to understand exactly why. And you're going to realize that the thing you've been calling discipline is actually a compulsion that's costing you more than you've ever calculated. But first, I need to show you what's really happening inside the mind of someone who can't stop being smart with their money. Think about the last time you did nothing with your portfolio for an entire month. Not because you forgot, not because you were busy, because you chose to. Because you looked at the screen, felt the pull, had an opinion, and deliberately closed the laptop and walked away. Most people can't remember a time like that, and the ones who can, the ones who felt that strange discomfort in their chest, that low hum of anxiety whispering that inaction is irresponsible, those people are the ones losing the most money. Not because of what they own, because of what they do. Here's what everyone gets wrong. They think investing is an activity, something you do, something that rewards effort, research, attention, and sophistication. And it does reward those things in almost every other area of life. Your career rewards effort. Your relationships reward attention. Your health rewards discipline. So it feels natural, obvious, almost morally correct to assume that your money works the same way. More input, more output, more attention, more results. But investing is the one domain in life where effort and outcome are inversely correlated past a certain point. The more you do, the worse it gets. Not sometimes, almost always. And the data on this is so overwhelming, so consistent, so brutally clear that the only reason it hasn't changed anyone's behavior is that it violates something deep in human identity, something you're not going to want to hear. Think about a garden, not a metaphorical garden, a real one. Soil, seeds, water, sun. You plant something in spring, you water it, you wait. A week later, nothing. 2 weeks, nothing. The soil looks the same. There's no evidence that anything is happening underneath. And so you do what any intelligent, engaged, responsible person would do. You dig it up to check. You just want to see if it's growing. You're not being reckless. You're being attentive. You care about this. You're invested. Literally. So you pull the seed out, examine it, maybe move it somewhere with better light, replant it a little differently, water it more. Feel better. Feel like you did something useful. The seed dies. Not because the soil was bad. Not because the sun was wrong. Because you touched it. Because your attention, your intelligent, well-intentioned, fully informed attention killed the thing it was trying to help. Now multiply that by every quarter, every earnings report, every market dip, every headline that says recession or correction or this time it's different. Multiply it by every time you log in, adjust your allocation, sell something that dropped, buy something that's rising, rotate into the sector that Goldman Sachs says is about to outperform. Every single one of those actions is you pulling the seed out of the ground. And the worst part, the part that makes this almost impossible to fix, is that it feels like gardening. It feels productive. It feels like care. You walk away from the screen thinking you just did something smart. You told your partner about the move you made. You felt the small hit of dopamine that comes from taking action in an uncertain world. You felt like you're in control. And control is the thing you're actually addicted to, not returns. There's a question that sits underneath all of this, and most people never ask it because the answer is too uncomfortable. If doing less produces better results, then what exactly have I been doing all these years? That's not a financial question. That's an identity question. And identity questions don't resolve with spreadsheets. Picture two investors. Both start with the same amount, same index fund, same decade, same market. Investor one reads everything, follows 3 financial podcasts, checks their portfolio every morning before coffee, has opinions about interest rates, sector rotation, earnings multiples. They rebalance quarterly. They sell when things feel risky. They buy back in when things feel stable. They are, by every visible measure, a serious and sophisticated investor. Their friends ask them for advice. They give it confidently. Investor 2 set up an automatic transfer on a Tuesday in 2014 and never logged in again. Not because they're lazy, because they're doing something else with their life. They don't know what their balance is. They don't have opinions about the Fed. They couldn't tell you what their portfolio returned last year if you asked them at gunpoint. They would probably shrug and say, I think it's fine. After 10 years, Investor 2 has more money, not a little more. Exposed to the same market, same fund, same contributions, they have meaningfully more. And the gap isn't from some magical advantage. The gap is entirely composed of the mistakes Investor 1 made. Every sell was slightly too late. Every buyback was slightly too early. Every rebalance triggered a tax event. Every emotional reaction to a headline shaved a fraction of a percent off the annual return. And fractions, over a decade, become a canyon. This is where it starts to hurt. Because you're probably Investor 1. Not because you're foolish, but because you're the kind of person who pays attention, who reads things like this, who wants to understand how money works. You're engaged. You're responsible. You're doing what a smart person would do. And the market is punishing you for it, quietly, invisibly, year after year, while the person who forgot their password outperforms you by a margin that would make you sick if you ever saw the actual number. Dalbar publishes a report every year. It tracks the gap between what the market returns and what actual human investors earn. Over the past 30 years, the S&P 500 returned roughly 10% annually. The average equity investor earned roughly 6%, some years worse, 4% of annual return, evaporating not into fees, not into bad funds, into behavior, into the gap between what the market offered and what people's decisions allowed them to keep. Over a career, a 30-year investing window, the difference between 10% and 6% on a consistent monthly investment is not small. It's not a rounding error. It's the difference between retiring with enough and retiring with roughly 3 times enough. The stupid investor, the boring one, the one who did nothing, ends up with approximately 3 times the wealth of the smart one. Same income, same market, same access, 3 times the outcome. The only variable is the number of decisions made. More decisions, less money. Fewer decisions, more money. It's almost offensive in its simplicity. But here's where the real shift happens. And it doesn't happen in your brokerage account. It happens somewhere behind your eyes, in the place where your self-worth and your net worth have been quietly fused together without you noticing. There's a specific moment that separates the people who will actually change from the people who will nod along, agree intellectually, and then check their portfolio again tonight. The moment is this. You have to accept that your intelligence is not an asset in this domain. It is a liability. Not always. The intelligence that got you to invest in the first place, that was valuable. The intelligence that told you to diversify, to avoid individual stock gambling, to start early, that was essential. But the ongoing, restless, always optimizing intelligence that makes you good at your job, that gets you promoted, that solves complex problems, that same intelligence is the thing reaching into the soil and pulling out the seed. And you can't turn it off. That's the real problem. You can't just decide to be dumb about your money. Your brain doesn't work that way. It sees a dip and generates a narrative. It sees a headline and constructs a response. It sees someone else making a move and feels the pull to do the same. The only way to beat this, and the data is merciless on this point, is to build a system that makes your intelligence irrelevant. Automatic contributions, automatic reinvestment, no login, no app on your phone, no alerts, no opinion. Not because opinions are bad, because opinions in investing are expensive. Every opinion is a potential action. Every action is a potential mistake. Every mistake compounds just as reliably as returns do, except in the wrong direction. Something changes in you when you stop watching your money. Not immediately. At first, it feels reckless, negligent, like leaving your child at a bus stop and driving away. Every instinct says, go back, check, make sure everything's okay. But after a few months of silence, something unexpected happens. You get your attention back. The mental bandwidth you were spending on markets, on financial news, on the low-grade anxiety of wondering if you should do something, all of it returns to you like a limb waking up after you've been sitting on it. And you start spending that bandwidth on things that actually respond to effort. Your career, your relationships, your health. The business idea you've been circling for 3 years but never started because you were too busy managing a portfolio that was managing itself worse every time you touched it. The irony is surgical. The less you do with your investments, the more time and energy you have for the things that actually increase your income. And the more your income increases, the more you can invest. And the more you invest without touching it, the faster it compounds. The stupid investor isn't just making more money in the market. They're making more money everywhere because they're not wasting their best thinking on a game that punishes thinking. But here's what this actually looks like from the inside. When your identity is no longer attached to being a smart investor, when you've stopped performing financial sophistication for yourself and others, something strange happens to the way you move through the world. You negotiate differently. Not because you've read a book on negotiation, but because you're not afraid. The money is there. It's growing. You don't need this particular deal. You don't need this particular job. You don't need to say yes to something that feels wrong just because the alternative is uncertainty. You have a cushion that you haven't eroded with clever moves. You have a base that's intact because you never touched it. There's a specific calm that comes from having money you don't manage. It's different from the calm of having money you manage well. Managed money requires ongoing maintenance, ongoing attention, ongoing proof that you're being responsible. Unmanaged money, money that sits in a system you set up once and walked away from, that money asks nothing of you, and the absence of that demand changes your posture. Your shoulders drop half an inch, your voice slows down in meetings. You stop saying yes to things out of financial anxiety and start saying no out of genuine preference. People notice. They don't know what changed. You seem different, more settled, less reactive. They assume something good happened. Something did. You stopped performing competence in the one area where competence is penalized. And this is where you need to be careful. Because if any of this is landing, If you're feeling the pull to change something, then you're standing at the edge of the most common mistake people make at exactly this moment. They overcorrect. They hear that doing less is better, and they interpret it as doing nothing is always right. They stop contributing. They stop thinking about their financial life entirely. They confuse strategic inaction with neglect, and those are not the same thing. The person who forgot their Fidelity password wasn't wise. They were lucky. The lesson isn't that ignorance is a strategy. The lesson is that the system matters more than the decisions. You build the system once. You choose the fund. You set the contribution. You automate the reinvestment. That part requires intelligence, real intelligence, the kind that designs a structure and then has the discipline to leave it alone. The intelligence that's costing you money isn't the kind that builds systems. It's the kind that can't stop tinkering with them. And there's another trap, the subtler one. You make the change. You automate everything. You delete the app. You stop checking. And then 8 months later, the market drops 20% in 3 weeks. And someone at dinner mentions they sold everything before it got worse. And your stomach drops. Not because you lost money. The loss isn't real until you sell. Your stomach drops because you didn't do anything. Because you just sat there while it happened. Because doing nothing during a crash feels identical to being out of control. And your entire identity, your entire professional life, has been built on being in control. This is the moment. This is where decades of wealth are either built or destroyed. Not in the planning, not in the fund selection, not in the clever allocation. Right here, in the sick feeling of a falling market, when every nerve in your body is screaming to act, and the only correct response is silence. The people who get through this moment without touching anything, they're the ones who end up with 3 times more. Not because they're brave, because they're absent. Because they built a system and left the room, and didn't come back until the storm passed. And by then, the garden had already recovered and grown taller than it was before. This is what the dead Fidelity account holders understood without understanding it. They didn't have nerves of steel. They didn't have some superior philosophy about market cycles. They had the ultimate behavioral advantage. They couldn't intervene. And the money, left entirely alone, did what money does when you stop interrupting it. It grew. There's a study that almost nobody talks about. Fidelity ran an internal review of their best performing accounts, the ones that crushed everything. When they tracked down the account holders, they found something that should have changed the entire conversation about investing forever. The best performers were people who could no longer make decisions about their money. The second best were people who had forgotten they had money to make decisions about. And you, the person who reads, who researches, who cares, who tries, you're somewhere below both of them. Not because you lack something, because you have too much of the one thing the market doesn't reward: attention. The most valuable thing you can do with your money is set it up once, walk away, and go live a life that's worth more than a portfolio screen. The returns will take care of themselves. They always did. You just kept getting in the way.